Hello and welcome to Williams Mullen's Benefits Companion, a podcast that helps employers navigate the complex legal challenges of managing their employee benefit plans. I'm your host, Brydon DeWitt, and today I'm joined once again by Ali Pino, Principal and Retirement Plan Consultant at Spherient Advisors. Welcome, Ali.
Thank you, Brian. It seems like this is becoming a regular thing.
Yeah, it's great to have you back on the Benefits Companion.
Thank
I
you.
thought it'd be a good thing to discuss today, especially with you and your industry, retirement plan fees. It's been a real focus area by the Department of Labor over the last several years, and certainly since at least 2019, we've had waves of 401k and 403b ERISA fiduciary litigation, where among the various claims that are pretty much being made in all of these cases, it's that plan fiduciaries have caused the plan to pay excessive fees, that participants are being charged more than reasonable fees. Under ERISA, plan assets may only be used for the benefit of plan participants and beneficiaries, for providing benefits to plan participants and beneficiaries, and for the payment of reasonable fees for administering and running the plan. And that's where that's really the issue. Are the fees reasonable? The Department of Labor requires certain vendors to plans to provide what's called a 408b2 disclosure. It discloses the fees, the direct compensation and the indirect compensation received by service providers. And then it's up to plan fiduciaries to read those disclosures and to determine whether the fees being charged to plan participants and to the plan are reasonable.
Right.
But to even get there, I think a plan fiduciary has to understand what these fees are and how they work. And it's not always that straightforward. And
Right.
so plan fiduciaries need to have a basic understanding of what the various types of fees that are being charged to plan accounts are. And I thought it'd be great if you could kind of give us some insight into the different types of fees and what you're seeing.
Sure. And I think you kind of hit the nail on the head. The intent with the fee disclosures was really good. It was to give in writing to the employer and to the plan participants what their fees are. And I think it's important that they understand it. The challenge was that there was no format for it. So everybody wrote it differently. So every fee disclosure that you see is different. Some include all fees on it. Some, for example, will exclude advisor compensation. So I think it's really difficult without having that knowledge, like you said, of, well, what are the plan fees that go into your overall total plan cost? Then you wouldn't know what fees to look for and whether it's a complete picture. So taking it back to kind of 401k plan fees 101, there are really three main buckets. And I think it's really important that these buckets are separate and independent of one another and not lumped together. Because if they are all lumped together, which we see a lot of times, you're not sure how much of each expense is coming from what bucket. So the first is your investment expense ratio. So that is what the money manager itself retains to pay to keep the lights on, pay the analyst, manage the fund. So think Fidelity, American Funds, Vanguard, T. Rowe Price, American Century. They have money managers they have to pay. So that's the actual expense ratio of the fund that you invest in. The next is going to be the provider or the record keeper fees. So that's what's your record keeper who's holding your assets. What are they charging to run the plan? That can be a billable fee. It can be an asset-based fee. So that would be, say, your John Hancock, your Fidelity, your Empower, those groups. What are they charging to hold the plan, do the statements, participant websites? And then the last would be your advisor compensation. So your advisor that's servicing your plan and working with you on the investments, employee education, plan design. What is their fee? And where it starts to get really muddy is when those fees are lumped together. So a lot of times kind of what's happened in the past is you would see revenue sharing used. So they would inflate the expense ratio of the fund to include the provider expense and the record keeper expense. And I'm sure you see this a lot. That's an issue.
Right. As you say, it can be really murky, especially if you don't have a format for providing the 408b2 disclosures. And I've seen these fees kind of sprinkled throughout a service agreement.
Yeah.
And then the service agreement says this service agreement serves as the 408b2 disclosure. Where as a plan fiduciary, I'd want a chart. I'd want something like a truth in lending statement that shows me what the fees are. So it's sometimes hard to even find the fees, and you really have to understand what they are.
Yeah, and I think if you are collecting fees via revenue sharing, inflating the fund expense, it gets murkier. And, one thing that you really want to look at for plan fees is making sure that your advisor is utilizing what are called zero revenue funds. So you just have the cost of the investment expense. There's nothing added on top. Now, you'll have some record keepers that will do what's called fee levelization. And while I think that that's a solution, there are two ways of doing fee levelization that one is actually not really correct. So think about it this way. If you have Fund A that has the cost of the fund, that's the participant's decision, whatever that amount is, and then it has 50 basis points or half of 1% added on top, then you have another fund, the cost of that fund's up to the participant, they choose to invest in it, but that fund only has 0.25% or 0.25% added on top. Well, the employee in Fund A just paid more for the plan expenses than the employee in Fund B, and they're all receiving the same services from the record keeper. So what some of the record keepers will do is levelize them. Well, if you're levelizing at a plan level to say, oh, we're going to get everybody to this amount and credit it back to the plan, you're not crediting it back to that participant. So that participant that paid 0.5% is still paying more than the participant in Fund B because they didn't get it credited back to them. And I know that sounds super complicated and murky, which is why we really never suggest doing that. We want it to be zero revenue and stripping all that revenue out of the fund so that it is clear cut, and that you, even if you're doing levelization, if it's not done back to the participant, you're actually still not satisfying that true fee levelization within the plan.
So what's the ideal arrangement, do you think, to help plan sponsors meet their fiduciary obligations and to be fair to participants so that one participant isn't paying more of a share of the plan expenses than another participant based solely on their choices of investment options? Is it just a flat fee per participant, or what do you see? What do you recommend?
So it would be zero revenue, not having any revenue sharing in the funds, which we kind of just talked about. And then fees can be either a hard dollar amount or they can be an asset-based amount. Now, kind of what you alluded to earlier is that the industry does say is an asset-based amount. It's pro rata across the board on the participants' accounts, which is 100% a suitable way to deduct fees. And that's how most do it. I think that most employers pass the fees along to their employees in either an asset-based way or a dollar fee. Now, a time where that may not make sense is, let's say that you have a plan where the trustees have majority of the assets. If it's a pro rata fee, they're going to be paying most of it anyway. What we would typically advise a client to do in that situation is strip the fees out of the plan. So you cover the advisor compensation and or the record keeper fee, and have that be an above the line tax deduction for the business owner. Since it's pro rata, they would have paid most of it anyway. So that's kind of one caveat, one different way of looking at it. But I think to your point of getting all things equal is really important. And I think also avoiding the pitfalls of plan fees, which is a whole nother discussion about what goes into plan fees. We see plans a lot of times that have a lot of what are called proprietary funds. That means using the record keeper's own funds. That means that record keeper is making more money on that plan that is actually stated in the fee disclosure. Those plans are typically getting audited and picked up for higher fees. And that's where you see some of those fee lawsuits coming into play. So that's where vetting the fund lineup and not really taking into account who's getting paid more depending on what funds you use is really important. And having a 321 or 338 fiduciary that says, I'm making the decision in the best interest of the plan, rather than, well, what would reduce the plan fees and what would pay me more. And that's kind of where this junk fee rule that we talked about in our last podcast kind of came up because of some of these issues that we're seeing with plan fees.
All right. So let's suppose that a plan fiduciary wades through all of this and understands the fees. Mm-hmm. How can a plan fiduciary determine whether the fees are reasonable and meet the ERISA requirements?
So what we do is we look at the plan on an ongoing basis. So we will do a fee benchmarking for the plan once a year and compare their fees to groups of their size through our system that we use to manage our plans. So we'll do that annually, but then we will actually take our plans out to bid every three to 4 or 5 years, somewhere around there. If they've had, say they had an acquisition and they acquired a bunch of new employees, then we would actually probably take them out to bid a little earlier. But it's important to do just the benchmarking once a year and then to take plans out to bid because services change, costs change. So when you said reasonable for the services provided, it's really important that you make sure that you're getting the best services that are available to your employees. And that changes over time as record keepers evolve, services evolve. And you need to make sure that you're benchmarking those as well.
Yeah, I think that's a good point. And it goes even beyond ERISA fiduciary duty and whether the fees are reasonable. But you do not know what services you're not getting if you don't take your plan out to bid on a regular basis.
Right.
So because you're not seeing what other service providers or other record keepers provide. I was sitting in one of these meetings with a client, and there were these apps on the phone and retirement trackers and everything online, and we didn't have that. So I was impressed and didn't know those sorts. This is several years ago, but really didn't know that it existed, and it just shows you that there's a benefit even beyond fees and ERISA and everything to going out to bid. But it's also important because there have been several cases where the courts have said when you evaluate fees, it's in the context of the services you're receiving, as you said. So there is an ERISA aspect to doing this, just making sure that not only are fees comparable to other service providers, but are they reasonable in light of the services being provided, and what are other service providers providing their clients? Yep. So I agree. I think every 3 to 5 years, an RFP should happen for those reasons.
We also do a provider checklist analysis every year with our clients. So we go through and make sure, because to add to this, and there's so many layers to it, and I don't mean to make it sound more complicated than it is, but we actually go through and make sure that did we receive the services from that provider that they told us we were going to receive? Because they can promise everything to you in a meeting where you have everybody come in and each provider presents their bells and whistles. But I can't tell you how many times that we go through that provider checklist and they didn't actually provide us that service. It's really important when you're in those meetings and you are deciding to move from one record keeper to another that you ask, well, is this a la carte charges? I want to know if I'm going to pay extra for this or is this included? And then make sure that you get it, because that's what that services review does. It's a spot check of did we receive them? And then we also are benchmarking the fees because it is twofold. And that helps stand up in a court of law if anything were to ever happen.
These are really great points and practical tips for plan sponsors. Thank you for joining us again on the Benefits Companion.
Yeah, you're very welcome. Thank you for having me. And I hope to go, what it would be, number 4?
Right. It would be. Yeah, this is the 3rd one. If listeners have any questions or suggestions about future episodes of this podcast, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.